Well, good afternoon, everybody. It's Colin, Mike, Matt, and Maynard with another edition of Close of Business Tuesday. We're really excited today because we not only have an investor, an investment firm with us, but we've got one of their more interesting portfolio companies. JP Bauman is joining us from Altera. You probably know them as an effort founded with some strategic capital out of some energy players, and JP and his team have been investing in the emerging energy world for a while now. We're going to get an update from him on what's happening in Altera, and then we're going to get a really exciting walkthrough from Kelcy, Pegler, and Yann Brandt. They're the CEO and CFO of FlexGen. If you don't know FlexGen, it's one of the largest energy storage companies in the United States. I think it's second. It's the single biggest in Texas. These guys have a solar background. They've seen a lot. And in FlexGen, what you'll hear is they see like almost everything. So it's going to be a really fascinating walkthrough with them. So JP and Kelcy and Yann, thank you so much for joining us. And as you guys get ready to flex your FlexGen muscles, let's check in with the team and see what's happening. Mike Bradley, how's that desk treating you today? What are the colors?
Yeah, Maynard, today is a little bit red, and it's been that way for the last week or so. I mean, if you've looked at the last week in commodities, you've had crude oil down a couple percent, you've had copper down a couple percent, Bloomberg Commodity Index down a couple percent, and the only really thing that rallied last week was lumber, which a lot of people have been looking at. And so, with that being down, you've seen energy was down about 3%. E&Ps were down a couple percent. So the trend was moderately negative last week, and it looks like that's continuing. And the reasons why are a couple. First of all, bond yields, about a week and a half ago, they peaked out at about 1.6, 1.7%. Now they're at around 1.56%. Number one. Number two, the Bloomberg Commodity Index, like I just said a little while ago, has come off here over the last week or two. It's really been on a straight up to the right path for the better part of a year. It pulled back in April. It rallied about 15% for the first 2 weeks of April. Now it's pulled back about 5% because of some of the issues we just talked about. And the third thing is, the momentum value trade. We've been talking about this for most of the year so far. Mostly that cyclicals were going to do better on the reopening trade, which meant value was doing better. And that's really worked well up until the last 2 weeks. And we've seen momentum start to take charge again. We've seen the ICLN, the Clean Energy Index, which has been under a lot of pressure over the last, year to date, has been up for the last week or so. And so we're just seeing a bit of a reversal in markets. And finally, the last thing I'd say as it relates to crude oil specifically, I think all the talk about is when is Iran, not if Iran is going to come back on, but when they're going to come back on. And the most recent talk is not only do they have 1.4 million of capacity to come on within 3 or 4 months, but the big line people have been talking about here in the last day or two is really how much they have in floating storage and how quickly that can come on the market. That wouldn't be coming on in months. It could be coming on in weeks. So that's kind of put a top in crude oil right now. It really hasn't pushed it down. It really hasn't put time spreads lower, but it's something in the back of people's mind. I think that's why we're seeing energy and cyclicals are going sideways to moderate lower. And so that's probably going to continue here until we really start to see inflationary data really start to pick up again, and we see a trend that way.
Okay. I don't know. It sounds like, Mike, people are sitting around thinking about negative scenarios. We need to put some positives in their Kool-Aid. I'm not sure, but we always take your word for it.
Well, you know what, Mayor, you really don't have any catalyst because remember, 2 weeks ago, earnings reports were pretty much done. So, we have another 70, 80, 90 days to go before we start to see earnings hit again. So there really isn't any real catalyst except for sort of macro type catalyst out there in the market.
Okay. All right. Matt Portillo, what do you got, my friend?
Yeah, I figured I'd share an updated macro deck we published about a week ago on the automotive sector heading into Ford's Analyst Day tomorrow, which the team will be participating in, given our recent launch on coverage for GM and Ford. So really wanted to walk you through here on this slide number 2 is really our updated forecast for electrification trends both in the near term and in the long term. And what we're seeing in the near term is that we're generally seeing a bit of an edging higher in EV adoption rates in countries like China, in the U.S., and in some of the European countries like Germany, Spain, and Italy, and a little bit of a tick down lower on France and the U.K. But when you pull it all together, it looks like consumer adoption trends are heading a bit higher than we initially forecasted for 2021, which for those that are following the electrification market is an important topic in conversation. The second update to the slide deck is really covering some of our longer-term trends. And one of the things that we went and did here was really try to match both the update to global policy, which we've seen continued push from both countries globally as well as states in the U.S. Towards electrification and pushing OEMs to invest in that direction. And we've seen pretty significant announcements, obviously, out of the likes of GM, who's planning on phasing out ICE vehicles by 2035, and heading into Ford's Analyst Day. I think you're going to hear a lot about their electrification strategy. Ford recently announced a MOU with SK to build out battery capacity of 60 gigawatt hours by mid-decade, and their demand in North America will rise to actually 140 gigawatt hours, which in our model equates to about 40% of their U.S. sales. And so the takeaway for us is, even though we're kind of nudging up our numbers in the near term a bit higher for our trends, we're actually taking up our 2030 forecast fairly significantly. We're seeing some pretty positive trends in how we think about the cost structure for the industry moving forward, as well as consumer adoption rates. And then the combination of that with policy and investment is going to take up our long-term forecast. So we did take up our expectations in China, in Canada, and the U.S. and European markets by 10 to 15%. And that will start to have some impacts to our longer-term gasoline demand forecast, which we cover on the right. As it relates to gasoline, our take is really there's really no change to our take in the near term. So by 2025, 2026 is generally when we start to see the peak in the market. The decline from that point forward to 2030 is fairly moderate. But as you can see on the right-hand side of this chart on page 3, there is a pretty significant decline as we roll into the 2040 timeframe. So something to watch. As a reminder, gasoline represents about 26% of the crude stack. We do see a very healthy recovery over the next few years, but for those thinking about longer-term demand trends, that will be something that will be important. And then lastly, just wanted to update everyone on our views around batteries and battery costs. As a reminder, we do have a fully functioning battery pack model that allows us to flex all the inputs in the battery cost structure. And because of the rise in nickel pricing as well as lithium and some of the other important inputs here, particularly around the cathode side of the equation, we did raise our forecasted range for battery costs this year on average for the NMC 811 battery to about $135 to $140 per kilowatt hour. So a little bit of pressure there from the commodity side of things. Big picture, however, we're still watching for updates from the industry around the potential to shift towards a more silicon-rich anode, which potentially could reduce the cost structure pretty significantly. And then longer term in the automotive market, we do see a lot of potential in the solid-state battery complex, and that was something that we talked quite a bit about with a bunch of panelists at our battery conference. So that's a quick takeaway. For those that are interested in more details on the report, feel free to reach out to your TPH representative. We'd always be happy to jump on the phone and discuss our views.
Thanks, Matt. I think it's funny, whenever you say that or anyone does, I get messages from my friends saying, I think you're my TPH representative. So I'm ready. I'm ready to field those calls, guys. Okay, Colin Fenton, what you got going? I know you got a smorgasbord of interesting things today. We heard it in the preview.
Yes, sir. Well, a couple things I've been paying attention to. Start off in Latin America, and recall that when we have the kind of macro environment that the guys just described, one of the great risks is that optimism gets ahead of itself and kind of ignores debt in particular. And in 1982, we had a double dip recession. Not that we're calling a double dip recession, but a lot of the same kind of fly up and then fall down dynamics that we might have to be worried about if we extend debt too far too fast. Are starting to show some warning signs. So, for example, in the bond market, Colombia's sovereign debt was cut to junk by the S&P folks on May 19th. The credit default swap 5-year is now at 142.939 basis points. That thing was at 84 in December. So still low. It's just been cut to junk, but a warning sign from Colombia. In Peru, the Peruvian sol is now trading at 3.8235 versus the greenback. That's 7% depreciation in a month. There are political considerations, elections in Latin America, but a warning sign. In the equity markets, Chile's Santiago Stock Exchange is down 17% in the past month. That's the third largest stock exchange in Latin America. So we have the bonds in motion. We have the currency in motion. We have equities in motion. And we obviously have debt and question marks about transmission rates of the virus. So just some things to be paying attention to on the margin. In the United States, we've clearly had inflationary metrics come out. We've had this debate about whether it's transitory or not. Of course, I think we all agree the real answer is some of them are transitory. Some of these pressures are not transitory. And that's kind of the thing to be figured out. But we did get confirmation in the Philly Fed report that the pricing pressures that were evident in April in the CPI and PPI prints have continued into May. 77% of firms surveyed in the Philadelphia Fed survey region reported paying higher prices in the month of May. That is the highest since March of 1980. So again, another print of 40-year highs in current instantaneous inflation pressures. And back to a point that Matt just made, even when we look into new energy, new tech, we're starting to see it bite in areas that have had really powerful deflationary trends. So for example, polysilicon prices are now trading just under $26 per kilogram. That was just over $6 per kilogram a year ago. It's forcing solar module costs upwards in really kind of a counter trend than what we've seen in recent years. And what's interesting is you're seeing macro traders sell the news. So the idea is now that we've gotten proof that inflationary pressures are in fact here, you're actually seeing the 10-year begin to come off, as Mike just said. You're beginning to see some of those indicators begin to quiet down a little bit. And kind of the scary thing there is markets are beginning to price in a rising potential for a surprise rate hike from the Fed, or at least tapering in a way that's perhaps more aggressive than had been anticipated. We also have the potential for easing sanctions on Iran, Venezuela, potentially with the June 1 OPEC meeting, a return of some of those barrels earlier than anticipated. And of course, we should be mindful that the fifth round of JCPOA talks are underway in Vienna right now. And as this video goes out on Wednesday, in The Hague, we have the Dutch courts rendering a verdict on whether Royal Dutch Shell is liable for human rights violations, that's the claim, on its customers' Scope 3 emissions and attendant effects on climate change. So lots of stuff happening. Basic point to distill it all down is we've had a lot of optimism in commodity markets in the past year. We've moved pretty far, pretty fast. But let's not forget that we came into 2021 with almost 13 million barrels per day of idled oil capacity. And of course, these very powerful trends pushing us towards new energy, as our guests will describe in a minute. And I just wanted to make one other point, which may have sort of slipped off the radar screen. The G7 climate ministers met virtually on May 20th and 21st, and they put out a communique, 27 pages long, which was interesting for a couple of reasons. One is they acknowledged expressly that the rich countries have promised to the developing countries $100 billion per year in financing. And that at times has been a little bit of a political football where you'll find some of the developed countries hemming and hawing about whether that number was actually promised or not. This G7 communique says it was promised. It was promised in 2009 at the Copenhagen COP meeting. What is interesting is, for the first time that I've seen at least, the document says that that money is only promised to 2025. Up until now, I've only ever seen that as an open-ended promise. So here we have kind of, yes, I owe it, but then slipping in this bookend. And I do wonder how markets are going to react to that, because, of course, if you're building in growth of $100 billion in CapEx out through perpetual time, well, that's a lot different than if you put a boundary condition on it just 4 years from now. And of course, we all know we're not getting anywhere near to 100 billion, even if we add in all of the private financing, et cetera. So making live projects like our guests all the more important to pay attention to. Also notable, we did a word count in the 27 pages, which, understandably so, has a lot of diplomatic kind of language and verbosity, and that's fine. That's what's normal for those kinds of documents. But the text uses the term finance or financing 39 times in 27 pages. And so this is a reminder that as we come up to COP26 in Glasgow later this year, it's all about the Benjamins. It's all about the money. And the word ensure is promised 25 times in 27 pages. And so one thing that has us a little bit nervous is it's one thing for the political and diplomatic world to ensure no one is left behind, ensure movement on some sort of goal or ambition or aim, to use the lingo of these reports. It's quite another thing to promise it in the context of financing. Under the securities laws of the United States and other countries, you cannot ensure outcomes. It is one of the biggest no-nos. You cannot guarantee a rate of return. You cannot guarantee some specific financial result. There are too many risks and contingencies that have to be acknowledged, both in theory and in practice. And so just keep that in mind. You may find that markets begin to see these promises and say, hey, wait a minute, I can't accord that 100% probability in a credit default swap, a currency, futures market, or whatever. And then finally, we had the Iea Roadmap. I believe Mike mentioned it briefly last week. And this also has us a little bit nervous because it is a very large document. In fact, I have it here on my desk, hundreds and hundreds of pages that really relies on some very aggressive assumptions that I think meaningful debate could agree doesn't have necessarily the highest probability of happening. And so recall that back in March, we discussed a panel that we did with ConocoPhillips for Baker Institute. Helen Curry and I reviewed the IEA's 5-year outlook for the oil market. And our view was that Toril Bassoni and her team had produced a very balanced, reasonable, great description of risk and responsibility kind of report. We were very impressed by it, I might add. And it really added to sort of a roadmap that made sense and was moving us in a direction. I would have to say this Iea report is somewhat discordant with that one. In fact, they don't agree with each other, just for starters, coming even from the same organization. And so it's a reminder that as we have these ambitions and aims and lots of ideas about what might happen in 2030, 2040, we really need to be listening to the lessons learned from folks in the field who have great experience with solar, wind, new energy, what's worked, what hasn't, how can we practically get to where we want to go? And so with that, Maynard, we thought that might be a good tee up for the expertise of our guests today.
Well, fantastic. Thanks, guys. I was going to say 2030 or 2040. All we know around here is that Christine Van Eef will be CEO of TPH. Today is her birthday. That is our forecast for the future. JP, it is fantastic to have you. Kelcy, Yann, great to have you too. Let's, kick off. Tell us what's going on at Altera, and maybe for our audience, a lot of us are familiar, but give us a little of the background. We're thinking it's been a crazy, active, interesting time for you, but I don't want to steal your thunder, but I know that's true.
Yeah, well, thanks, Maynard and team for having us. Great to be here. For folks that aren't familiar with Altera, we're a Denver-based venture capital firm. We were founded almost 25 years ago, and over that time, we've now raised and invested 6 venture capital funds, made investments in over 60 companies, exited out of all but 5 of those. We have 5 portfolio companies at the moment. I think just a little bit more about us. We think of ourselves first as company builders. So we work very closely with the entrepreneurs that we back to help build and scale important companies for the energy and broader industrial space. We do focus on technology and software that is applicable to the energy and industrial space. And I think another really unique aspect about Altera is we invest in a partnership with a handful of U.S. super independent oil and gas companies. So folks like Pioneer and Apache, Devon and EQT, and soon to be others. We work with them in a very structured way over the life cycle of what we do. So we start with what are their pain points? What are the big problems that they're trying to solve, both in headquarters of digital type solutions to things in the field, to how are they looking at the energy transition and things that might be slightly adjacent to their core. And so that's really where we will look for investments, is where our partners are finding the pain points, finding the need. And so,
JP,
I guess I'm sorry, go ahead.
I was jumping in, JP, but is that the core of your investing base? Are there others? Are there financials, or is that kind of pretty much the group just for everybody's benefit?
Yeah, so half of our capital base are strategic, independents, and the other half are your traditional financial investors, institutions, and groups like that.
Okay, thank you.
Yeah, and so again, we'll invest across that energy, landscape. And I think probably the best way to describe kind of what we do. I mean, we invest in companies like Seek, which is a big data analytics company. We just did a big round with Insight Partners, to a company like ThoughtTrace, which is using artificial intelligence to do contract review and to pull out risks and obligations within your commercial contracts and documents. And then, of course, groups like FlexGen, which is we'll talk more about, which effectively is enabling the integration of energy storage with power generation assets like solar, like wind, like natural gas, so on and so forth. And so I guess after deploying this model in our most recent fund, this partnership model, we're kind of here to report it's been incredibly successful. We have 5 portfolio companies that are all thriving. Great, backed by great teams that have led us through some of the challenges we've had over the last couple of years. And again, this partnership model has allowed us to identify great companies and then scale them very quickly with customers, as well as involve customers that can help really shape and guide these technology companies to their spec.
So JP,
and last thing I'll say is we are raising our next fund, which will continue to build on that success of Fund 6. So.
My impression is people knew you had strategic investors, but the point you put on it, which is that one of the things besides money they give you is just insight into, gosh, I wish we had something to solve this problem, or, here's how we could be made better, or that type of information, which is really, I assume, super critical as you think about investments.
Yeah, it's very critical. I mean, as you know, our industry isn't necessarily renowned for adopting things very quickly. And so, we're also focused on things, not incremental improvements, but real step change improvements to our industry, how we can really change, change the way the things, change the way we do things, both from a cost standpoint and as well as on a revenue standpoint, right? So I think that insight's super critical. I would also say that it's not even just on the investment decision process. We really facilitate a lot of interaction between our portfolio companies and these investment partners of ours. So if you think if you're an entrepreneur, you no longer have to develop your technology or software in a vacuum, right? You can actually get direct voice of customer feedback. And the operators love it, right? I mean, how many times do you get a chance to tell a vendor how you want the solution to look at the end of the day? So entrepreneurs love it, the operators love it, and again, the net result has been a set of portfolio companies that are really thriving and delivering really real value, not only to the energy industry but beyond. I mean, we invest in companies that have cross-sector application when possible. So.
And it sounds like you named a number of oil and gas companies that were involved, but are you thinking of adding other industries, other strategic players? Like, is it widening out as you think about building the effort there?
Yeah, for sure. I mean, that's definitely something we're thinking. Our operators, one of the things we do is we'll bring them together in different workshops where they get to, talk with their peers, different subject matter experts, around maybe a certain portfolio company or a certain topic. And we're finding that, these challenges that our oil and gas companies are trying to address exist in other industrial verticals as well. This whole quote unquote digital transformation that's happening, there's so many things that have cross-sector application that, we've really seen a benefit of having a diversity of sort of viewpoints, and certainly groups that are coming from outside the sector can bring a lot of value. So our operators have looked, said, yeah, let's bring in different groups, whether technology companies or different industrial companies, because a lot of us are trying to solve the same digital problems, the same ESG challenges, so on and so forth.
All right. Well, I mentioned you brought along one of your favorite portfolios. I know this is like children. You can't have a favorite, JP. You love them all. But the
right.
FlexGen guys, the FlexGen business model, as you mentioned, one of the largest storage companies in the country, the largest in Texas. And, the way, what could be better, Kelcy and Yann, when you think about all the ways in which the world is changing? It's in a business like yours where power's coming from all different places and there's all kinds of dynamics going on. And we're constantly changing the mix of what's producing what. So welcome, Kelcy and Yann. And I mentioned in the lead-in, you guys both have a solar background, but now you're, exposed to everything. So let me jump in and anybody go first. We just want to hear more about FlexGen. And then you can tell us, is JP as cool to work with as he seems to be?
He's as good as he sounded in his intro. And we take a little umbrage that we're one of his favorites. He makes us feel like we're his favorite all the time. So I'll check out afterwards. But thanks for having us. It's a great time to be in battery storage. As you said, Yann and I both come from the solar side of renewables. And when we looked at FlexGen for the first time, we took notice of the battery storage space at large and said, geez, I don't think there's a more advantaged vertical than battery storage in all of business. And then really looking at where FlexGen is and where it's come from and the capabilities that it has, we're proud to know that we think we're the most advantaged company within the battery storage space. I think of most interest, there will be more first-time battery storage owners in the next 12 months than there are battery storage owners up to this date. So it's a really exciting time to be an enabler in the space. We're spending a lot of time and effort right now on automating some of the feasibility process for storage. Oftentimes, or the most common conversation we have in and around the space are asset owners saying, does storage work here? And finding a way to meet those partners at that discussion point and help them figure out if storage works for them in their specific use case. That's always the first of 4 questions. The second, after does it work, assuming it's a yes, is how big should the storage system be? And we can answer both of those questions pretty independently. The third and fourth question become a touch more collaborative in that the third question is always, how much will it cost? And for us to really provide some definitive insight, we need to know the use case and how that system will be used. And then finally, as you could have guessed, it's how much money will it make to get some type of ROI calculation. So FlexGen, we've gone a long way in automating a process to affordably and efficiently, by time and effort, help our universe of customers figure out if storage works for them, what the type of cost profile will be, and how much money they could earn from their battery storage system.
So Kelcy, one just terminology question. When you say that stat you had about more battery storage owners will be created this year than in all of time, something like that. What would be the definition of a battery storage owner? Like, is that as small as like a single consumer as well as a power company? Like, what's the range there?
Maynard, I feel like that's a trick question. With the amount of prognostication in your group right now, for me to go into a hole of that depth is irreversible. So I'm gonna stand on the very nebulous stat that I gave you and let somebody fact check it for me.
Okay. Hey, Kelcy, you're a guest. We're good to our guests, so we're going to let you do that. Yann, what would you throw in after Kelcy's introduction to the company?
Yeah, I mean, look, it's all about enabling any interconnection point, right? So the big question, even though we come from the renewable side, I come from more specifically development of renewables, but all energy development at the end of the day is very similar. And one of the things that you tend to find in investment committees as developers try to get the investment committee to greenlight a project is the notion of a perpetual interconnection. And so whether it's a landfill gas or some, now some coal plants that may be thinking about shutting down or have shut down, the value of the real estate and the interconnection point still remains. And in the world of energy storage, particularly in markets like ERCOT or PJM or CAISO, you really start thinking about the use case of batteries in a world where you're not actually seeking an off-taker and you're eliminating the biggest time risk in the development. So if you have real estate and interconnection, the power markets themselves are already, providing you the revenue opportunities. And then it's all about pairing the right investor to that project. And having spent 15 years in renewables, where convincing someone that they're signing an offtake agreement now is the right time to do it, eliminating that from the development process is probably the most exciting to me, especially from FlexGen's perspective, where we have the unique technical capability of actually getting someone to ready to build stage once they have the green light from their investor.
So guys, what tends to drive your business? I know it's a lot of things, but one of them, we saw it in Texas, we've seen it in California, is like reliability. Like, I want to know that I have power no matter what. The other one, of course, is just the growth of renewables and where you decide I need to coexist or cohabitate that with what you're doing, or how would you describe for us the drivers in your business, and which ones are bigger than others and which places are bigger than others?
I would say it's profitable altruism. It's wanting to do good, make a more resilient grid, and a more intelligent grid. We're finding that the use cases of battery storage are not always what the original plan has been. I think the Texas freeze over will end up landing as really informative for how battery storage could and should perform, certainly during a black event. But under normal circumstances, I think battery storage is proving to be a real connector in this grid transition. So as we see renewables come online, we see distributed resources come online, battery storage ends up being very complementary at a minimum. And in some of the best use cases is helping to optimize the plans of these grid operators and asset owners.
Kelcy, maybe to follow up on that conversation, looking at the automotive market, I mean, there's just absolute massive growth to come. And to put this into context, in 2010, we had production capacity globally of about 20 gigawatt hours. In 2019, coming into 2020, that's expanded to about 300. And then as we look at the plans over the next decade or so, there's easily a tripling of that capacity. So huge scale coming on the automotive side of the business. I was wondering if you might be able to frame up the market potential or just your views around the nascency of battery storage for solar and wind as backup capacity, because it feels like we're starting to reach that tipping point where there's a huge amount of growth coming down the pipeline, and what that ultimately means to the business model moving forward, as well as maybe sourcing capacity on a global basis, because I think that's kind of an important topic as well.
Yeah. So I'll attempt to answer that by saying the battery storage market feels almost exactly the same as what the solar market felt like about a decade ago. The universe of participants are asking the very same questions that solar was asking. What geographies are best? What are the best use cases? What's the regulatory environment? And the very same questions from the solar space are being asked of storage. So Yann and I often talk about the deja vu moments that keep bumping into. From a macro trend, it's funny to hear the very intelligent forecasting that this group is doing, but I cringe at thinking back to all of the forecasting that was done on solar, and it systematically under forecasted two main things: the pace of adoption and the rate of cost decline. We can't say for sure that batteries will see that same pace of adoption and outperformance on cost declines. But we certainly saw that on the solar side, two different businesses, but both with a hardware and a technology component. So it'll be interesting to see. We see some of the very same signs of the opportunity to outpace the forecasts just by right now, you've seen the early movers invest in battery storage and operate it and working the kinks out of a nascent space and figuring out what the right use cases are. I alluded to that earlier, but you see everyone run through their pro formas. I'm going to get this battery system and it has a 20-year useful service life. I'm going to cycle the batteries 2.5 times per day, and this is how I'm going to apply it. And then you bump into your first black swan event and you realize if you redline your batteries for 3 or 4 days, you're going to outperform your pro forma by 10 years. And in most cases, you're going to be really compelled to consider doing that. So at FlexGen, we have a very interesting seat at the table in both helping our customers run their batteries and make sure when the bell rings, the batteries perform, but then also forecast what are we doing to the service life? What does this mean to your pro forma? Have we reduced its useful service life? And the more reps we get and the more data that we see, the more informative that will be in helping this next group of owner operators perform with their battery system. So it's a really interesting seat to sit at that we have at FlexGen.
So let me give you one data point. When Colin started talking about the Iea report, I wanted to try to find something, and you walked me right into a statistic here. So in the 2012 World Energy Outlook, the report calls for a 4% electric vehicle adoption globally by 2035. And last year's World Energy Outlook, we were at 2.6%, right? So the reality that one of the places where solar diverts from energy storage is that from our part of energy storage, regarding your supply chain question, is that we get to ride the coattails of the transportation sector, not just light duty consumer vehicles, but even everything else that's where batteries are charging everything. Tesla's always called the vehicle, or has called their battery unit, stationary storage, which always made me wonder why they called it stationary and not call the cars unstationary storage. And Ford obviously releasing the F-150 showing intelligent backup power, but essentially a giant power bank to plug your home items into. There's going to be some vehicle to grid technology that enables some of the DERMS markets that might be interesting. And then kind of forecasting two things that I always bring back from a market standpoint that I think are timely. The power markets still have not really shaped the pricing and the pricing signals, both on the supply or demand side, that take into account the capabilities that energy storage allow, both on the distributed side and the utility side. And this whole shift, this World Energy Outlook, the disparity between where we are in 2020 versus where the 2012 forecast was versus what it's actually going to be. BP filing to be a retail energy provider, kind of intersecting the worlds that you all spend a lot of time in. That is the electricity is the new oil or is the new transportation fuel. And, whether it's Vitol financing the electric buses in Colombia or BP becoming, trying to get into the fleet retail providers for, school buses and other items, this intersection of electricity to oil for transportation, at the end of the day, what I always say internally as well as to investors is batteries are the dampers and the springs that are going to allow the flexibility in the grid to expand and contract, both on the variable nature of the generation that's going to continue, as well as the variable nature of the demand. And this is, when we talk about climate tech, we always talk about the intersection between the hardware that enables this damper to exist, but more importantly, for the software that enables this to happen automatically and intelligently, because we're quickly getting past the way that the old generation was being managed in sort of a Homer Simpson fashion versus this massive decentralization of how energy storage assets are going to run the grid in the future.
One point on that, I totally take the point about the 2012 WEO from the same group that produced the two reports, one of the two reports I just mentioned. And what I would point out in that report, the roadmap, and even in the G7, is the lesson they took from Winter Storm Uri is that you have to increase interconnectors. So, think about that, right? Their conclusion was massive investment is necessary to connect each of the disparate regions so that they're all put together, and it's not a battery solution. And yet, that would be obviously counter to this business model. I think you'd find a lot of support among our audience for the fact that you're already doing it. So I guess my question is, it maybe be helpful for the audience. Kelcy, can you describe a little bit about what a unit looks like? When you bring it to an oil field, what is the actual use case that you see there? Because I think it really underscores why you don't need to necessarily have the interconnectors, and that your model very well could, just blow past this forecast. And 6 months from now, people look at this 2021 Iea report and they're like, I don't need to wait 9 years. I can already see that these two curves are moving in different directions.
Yeah, it looks like a rectangular, sleek shipping container, depending on the size and the hardware. They are rectangular boxes. If you took a shoe box and turned it on its long end, similar to that, and then depending on the size, depends how many shoe boxes you have in the field. But yeah, they ship almost ready-made, where the batteries in their containers ship to site, and then the valuable work is making sure that they're connected properly, that you have the right power electronics, that you have the right management systems, and really what the early movers in battery storage have come to realize is that connectivity between the hardware and the software is what's literally determining the winners and the losers in the space.
So JP, maybe we could pull you into this conversation. I think the trends that you see, and this is probably part of your investment thesis. You saw new usage patterns, new production patterns, bottlenecks, reliability issues, growing demand for electrification. Like I'm guessing when this investment memo came up, you were saying, okay, what trend does not drive this business? But what was your perspective on all this, and what led you to make the investment?
Yeah, well, I mean, there's some interesting history here. I mean, we made this investment in 2015. And, at that point, FlexGen had success basically deploying these boxes like Kelcy just described into military applications, where they're hybridizing things like generators that are powering remote operating bases in Iraq and Afghanistan. And our capital came in 2015 to start applying that same hybridization technology to things like drilling rigs or, edge of the grid artificial lift type applications. And, that 2015, 16, 17 timeframe, I mean, the value proposition was, you're eliminating the number of diesel generators on your drilling rig. You're creating higher power quality on that rig, reducing blackouts. You're paying less fuel, and you're reducing emissions. Well, to be honest, that value proposition hunted for, a handful of operators that adopted these, sort of drilling hybridization technology. But we really, 2017, 18, we ended up pivoting the business because there just wasn't that kind of uptake that I think you would see today. The operators in the oil field are thinking of this differently. But we said, we're going to pivot this business. The technology, the software was there such that it could apply to kind of where our business is at today, but that's more utility scale applications where we're taking our technology and applying it to existing solar fields, wind, natural gas production plants, things like that. I think the oil field is probably starting to catch up. They're back to say, hey, maybe we are interested in that value proposition. We do care about lower fuel costs and emissions. but it was really interesting. This company was always had that base technology, but the market sort of has caught up to them now in a bunch of different ways. So it's been an interesting pivot as small companies can do. So.
Yeah, I can't even believe as I was ticking off all those trends, it's the first time in the history of COBT that I didn't mention ESG. But it's obviously it's present everywhere.
Yeah.
Maybe I got one more, and I think Matt's going to jump in with one. But just looking at the website, guys, and we'll attach a link to this so people can learn more about FlexGen. But you've got operations in Russia. You are in a lot of remote places where power issues and reliability are always key. Any adventure stories for us from unique global locales where you managed to put power in that kept people going?
I feel like I'm not worthy to share this story because I had none of the effort involved in doing it, but and I won't do it justice, but I'll give you the punchline. We had one of our colleagues get to a site missing a widget, took an 18-hour train to go pick up this widget, and then an 18-hour train back to plug in the widget, which made the standalone storage unit work. And that was an interesting story. The guy happens to be an Army Ranger, so I don't know if he didn't have that capability or that experience set, if he would have been able to pull it off.
Now, you mentioned, sorry, Matt, I'm jumping in, but there are you do have a lot of veterans and, interesting people working at the company. What would you tell us about the team?
We have some really smart people, veterans, and all kinds of diversity within the business. But we've really been on the leading edge of storage, and that's meant different things at different times. JP talks about the military microgrids. We're now looking at things like hyperscale data centers. And all of that is enabled by some really smart people that have contributed most of their life's work professionally to battery storage. And Yann and I, as the recent leadership team to come in, certainly are proud and advantaged to have joined such a capable team.
And I should add that we are actively hiring both on the software and hardware side. So we'd love to have more smart people join the team.
Yes. If you know any great software engineers that like to do good, that we have a great position for them.
Kelcy, maybe just a high-level question. I'd love to understand maybe the value proposition on the storage side. The work that my colleagues have done on the research front is very interesting around the cost structure for standalone solar and standalone wind, but obviously as an industry, we constantly talk about intermittency and backup generation. And right now that's met with gas-fired peakers or potentially some other options in the market today. But I was wondering if you could talk a bit about kind of how batteries stack up in the cost structure, and ultimately as you guys look at the technological innovation on the horizon, what makes you most excited about this opportunity set?
Well, without getting into the weeds, which Yann could if you wanted him to, after hearing him talk through it, I promise you and your listeners don't want to get into the weeds on cost structure, but I'll say the numbers work. The numbers work in almost all use cases right now. So when I talked about that feasibility process earlier, there's very few, if any, that go through that first gate of does storage work here without the answer being yes. It starts to become really intriguing from if we get an ITC extended into standalone storage because it works, and that could make it even more compelling of an offering. But I think everyone in and around the space and customers and homeowners and businesses alike ultimately benefit from battery storage adoption. The more there is, the more resilient and intelligent the grid can be. And I don't mean for battery storage to take all that credit. I think battery storage becomes the connector for a lot of the grid transition that's occurring. So the numbers work now, they're getting better. And I think we'll see more and more battery storage in the coming quarters and years.
Guys, as we're probably wrapping up here shortly, you guys have been great with your time. One question maybe just about the technology and your suppliers and your partners and how you see that changing, improving. People are always talking about battery breakthroughs, et cetera. What would you tell us about that host of kind of topics?
Yeah, we're rooting for all of these science experiments and chemistry opportunities and cost declines. We're hardware agnostic, and we're really rooting for every type of breakthrough because being hardware neutral, as Yann prefers us to say, we have the ability to co-benefit or mutually benefit from all those improvements. So I don't know that we would hang our hat on anything transformative today. We're certainly seeing the battery performance improve. The data is very helpful. I think we'll see that in the automotive space and in the battery storage space. And we'll keep our fingers crossed for some transformative science experiments to come through.
Well, all of us on that front. Maybe, Yann, one thing that you guys referenced a couple of times up front was, then finding an investor. So would you mind just making sure we understand? Because I probably took that to mean you can decide to have your own battery backup, or you could, sign an agreement to purchase power from the battery backup and somebody else owns it. But I'm getting ahead of you. Maybe just unpack how you finance this whole thing and what are some of the financial nuances.
Yeah, so first of all, just to kind of frame us in the ecosystem, we're a technology partner to both the construction companies as well as the investment vehicles that own these assets, build and own these assets. So, we do direct work for many muni and co-op electric companies, but a majority of our business is with investors that want to own portfolios of energy storage companies. So we help them build it, and then our software enables them to maximize the revenue streams through it. That's it. It's really an interesting question. And it's part of the conversation that's happening in the market right now. The question goes something along the lines of, are contracted cash flow investors, infrastructure funds that own solar and wind farms, interested in owning merchant storage assets in ERCOT, or are merchant ERCOT energy storage assets going to be want to be owned by trading desks that are more interested in trading physical electric commodity versus the paper traders, right? So who's going to own these assets and what kind of risk appetite are they going to have? Here's what I'll tell you. And, so there's the solar plus storage, wind plus storage, arbitrage opportunities that are kind of like contracted cash flows, and some of the PPAs have the contracted cash flows. When you buy a solar farm or invest in a solar farm or a wind farm, it is really hard to outperform your pro forma after you've installed the asset. You make that investment once and you're seeking the longest opportunity to contract that cash flow so you can lower your back leverage and create your upside that way. With energy storage, you choose your market every single day, right? If you're a merchant trader of that asset, in a way, you're commoditizing the electricity, even if you're the generator on it. So, do I charge this? Look at the peak pricing in Winter Storm Uri. That was at 1:56 a.m. when all ancillary services plus energy was something like $30,000 a megawatt hour, and that was a frequency regulation event. You never know what your performance is going to look like with energy storage. But LS Power probably has been the most public around the fact that during a California peak event, they paid for their asset in their first week. And that's typically how I lead any conversation with someone that's interested in energy storage. But I'll sort of leave you with this. Almost every single investor in the energy space today that's thinking about energy storage is thinking about buying their first asset ever. And the amount of investors that actually already own an asset is minimal compared to the entire universe of the $1 trillion opportunity that's in this energy transition, multi-trillion-dollar opportunity per Ernst & Young yesterday. Almost no one in that portfolio of investors owns a storage asset yet, but they all will within a year or two.
Wow, that's fascinating. Well, it comes back to your comment, Kelcy, about we will create more battery storage owners this year than have previously existed. So it's pretty phenomenal stuff. I feel like right there at the end, just as we're probably wrapping up, Yann, we hit the 1.21 gigawatts of, I know that joke's been used before, but we really hit the money is really it's really big in this whole thing. Well, guys, JP, we want to thank you. Good luck with all the work you guys are doing at Altera, and thanks for bringing Kelcy and Yann. Guys, we really enjoyed it. That was fascinating and great to see. We'll see if you get some software designers hitting the bid after they see this video.
Looking forward to it. Thank you, everyone.
Thanks, guys.
All right. Thanks everybody.
Thank you.